Hello, everyone. Welcome to another episode of the Index podcast, where we come together every couple of weeks to discuss on-chain data, chart crimes, and metrics that move the crypto industry. Today, I am joined by my co-hosts, Denning, on-chain corgi at Flashbots, Hildobby, resident data wholesale at Dragonfly,
Hello.
Charlie, our guest for today, who's the king of data and co-founder of RWA.xyz.
GM.
And I am Boxer, and I am the community power horse at Dune. Before we start, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We are acting independently of our respective professional roles here. And with that, GM Charlie, I'm very happy to have you here. RWA, of course, the premier data website for all things real world assets, to unpack that acronym one time. Maybe tell us about how you got into this like real world asset niche. What's your journey to like found RWA.xyz?
Yeah, and thanks guys for having me. Listened to a few episodes of the show in the past, and as a fellow data nerd, definitely enjoyed it. You guys are filling a niche here in the space for sure. So, but in terms of how I got started in the space into what we're doing now, we originally actually started off as a DeFi protocol on Solana that was doing yield aggregation. And so we got a really good sense of just all the ways to generate yield in the space, from Olympus DAO to, this was late 2021, early 2022. Everyone was farming Anchor. There was, Aave Compound, standard lending markets, Uniswap LPing, stuff like that. And we really only saw the real world asset interest rate generation as the one that was going to stick around for the very long term, and thought that was going to be the primary use case of crypto, that and payments going forward into the long-term future. And so after all of the Luna yield and everything like that dried up, yields on a yield aggregator went down to 2-3% and no longer a good business to run. Decided to pivot into something to do with tokenization. Talked to hundreds of people in that industry, and it became very clear to us that really no one had any sort of data that was available on what was going on chain. And we initially started the site as just something where it was an excuse for us to talk to people to find the real idea. But then Alameda blew up, and coincidentally, we had all the data on where Alameda was borrowing in DeFi. They were using TrueFi and Clearpool and Maple. They're borrowing from all these places, in addition to the Aaves and compounds. And we had all that data, and so our site kind of just blew up from there. Got a lot of Twitter followers right during that time, and it became clear to us that maybe this is actually a thing. Maybe we should just be focusing on giving people the data and the insights on real world assets, real world lending, everything like that.
Very, very interesting. I think I saw this quote before. Someone said that, it's well known that like blockchains are transparent and everything, and the data, when you think of this before you dive into it into blockchain, it seems like it's very accessible and super easy to get. But the truth is it needs to be ingested and be digested and actually be shown into charts that are curated. And I think that's a huge job that a lot of people don't really see until they realize, the data they need might not be easily accessible, and doing it in-house is actually one hell of a job. And I'm guessing that is this the exact problem you guys came to fix, which is really cool.
Yeah, exactly. We actually found that for us, because there aren't that many other sources for this kind of data, you do have to go into the depths of Etherscan and Dune and everywhere to get it. It's a lot of times what we're competing against when we sell this data is people doing it themselves, and standing up an engineer and an analyst and everything, the whole team to do it themselves.
Yep, very interesting that you're also like kind of from the I'm also of the yield farming generation of 2021. I started with Pickle Finance and Yearn and those folks. And interesting that you guys were probably doing the same stuff over on Solana.
So you started really yield farming, got into RWAs. When did you make the switch exactly? And also, I'm curious, what was the name of the company before your? I'm guessing it wasn't RWA or XYZ for yield farming. So yeah,
It was called Castle Finance, and you can actually see the site live still at castle.finance, which is a fun fact that you'll see our company name all the way at the bottom on both sites. But we made the switch in the summer of 2022, right after Luna had collapsed. It was actually very stark. I actually don't know if you can still see it on any data site now, but every single yield aggregator on it, every chain that had a bridge over to Terra, every single yield farm went from 15-20% yield to all the way down to like 1 or 0% in a matter of days, just because that was by far the primary source of yield in the entire ecosystem. So very, very stark to see. And what we did was we took about 2 months just to figure out what we wanted to do. And it was very fortunate that the domain RWA.xyz was available. So we actually took that before we knew what our product was going to be. Just so happened that it fit extremely well. We didn't even need to go on the secondary market for that domain either. Got it for $200 just on GoDaddy, which was very fortunate.
that's one lucky domain get. Nice one. And yeah, I'm glad you guys get it because you have a fantastic website. How much time did it take from you guys from starting and having your idea set to having your first dashboard and first data actually available and publicly available, I guess.
Yeah, great question. We built out the MVP extremely quickly within a few weeks, and all it consisted of was our goal was really just to see, okay, does anyone actually care about any of this data? So wanted to build it out as quickly as possible. And all we did was ingest all of the data from each of the partner APIs. So Maple is API, Centrifuge API, Clearpool, Aave Compound, etc. And pulled from their GraphQLs into a just Postgres database using Meltano, like BI type tooling, and from there just wrote dbt queries that we would automate using Airflow to run once every hour or so, and our website front end would just ping the database directly. Very little infrastructure at that time, but it got the job done and actually stuck around a lot longer than we originally intended. We actually only migrated fully off of that stack about 6 months ago. So it lasted for well over a year, which it was definitely not intended, but that's what happens sometimes.
Nice. Before we look into the data, could you define what real world assets are to you in a few words? And maybe we can start from there.
Yeah, this is a surprisingly controversial point that actually comes up a lot in different group chats that we're a part of. I would personally say that it is any financial asset where you have a legal claim in a real court to your ownership on chain, where if you have the token or you have whatever method of ownership on chain, that you can, if things go wrong, you can go into a real life court and get your money back or enforce your claim in whatever way.
Okay, that makes sense. I think the concept is therefore closely attached to tokenization in general and tokenizing assets. And I looked through your blog posts and you had one about the spectrum of tokenization. So I'm just going to quickly share my screen and maybe you can talk a bit about it. So this is the slide that is part of the presentation, and I thought it was really good. And I agree, like many other things, where it's not black and white, and there's nuances to this. And yeah, could you explain what those are for RWAs?
The Spectrum of Tokenization was a report that we had put out maybe about a year ago, and still I think doesn't get enough play in the broader conversation, where we recognize that not all assets are either fully on chain or they're not fully off chain. They're not fully legacy, where all of these protocols, issuers, anyone involved in the space has to go through this spectrum. We labeled it from Model 1 to Model 5, where Model 1 is status quo. It's not on chain at all. Model 5 is fully on chain, where all of the claims are enforced on chain. And it's actually not even possible to get to Model 5 without the legal system being friendly to on-chain enforcement. Only possible in some countries like Luxembourg, Switzerland, and a few others. But to briefly go over the different models, you have the status quo, Model 1, Model 2, where you are putting the enforcement or the enforcement stays off chain. You're representing the assets on chain, but you don't have any money flows yet through the chain. So broadly, this would be somewhere like Figure and Provenance. They feature prominently on the site, and when people ask us, "Is this really tokenized?" And we would say, "Yes, it's actually Model 2 tokenized." Maybe we need to do a better job of displaying that. And then you have many of the other protocols like Maple, Centrifuge, Securitize, all of these guys who are Model 3 and Model 4, which means that not only are the assets on chain, but they do have those cash flows flowing through the on chain as well, mostly through stablecoins. And then, like I said, Model 5, which is where you have to it's natively issued on chain. There is actually no off chain component as well. And over time, particularly in TradFi, you can see a lot of these different protocols moving through the spectrum. And so we want to do a follow-up on this, where let's take Franklin Templeton as an example. 1.3 trillion or so asset manager. Most of their assets are status quo and Model 1, but they only recently have, maybe about more than 3-4 years ago, started with a money market on chain, actually on Stellar, interestingly enough. Started with Model 2, where it was represented on chain, but if you want to actually buy it, you would still have to just send them money like through a regular wire. Then they moved to, about a year ago, to Model 3, where they actually had the flows, like whenever you'd subscribe to the asset, that would be on chain as well through stablecoins. And then only very, very recently, 3 to 6 months ago, did they move to Model 4, where they got rid entirely of their traditional transfer agent, which is who keeps the books of an asset. And now they're entirely keeping track of ownership on chain. And so we think that traditional institutions they're at the forefront of this, but we think that this is the path that all traditional institutions will eventually have to go through.
Okay, so there's some evolution, and I think it's still the case maybe a bit, but a few years back it was a big thing to have blockchain or AI on your LinkedIn, even though it was just bullshit. And I think I'm seeing the same migration where at first it's kind of like Model 1 or Model 2, where it's very lightly used and mostly maybe for, hey, we're innovating purposes, but is it actually useful? But we're actually seeing evolution into a more decentralized system that actually makes sense. And that jumps me into my next question, which is, what should we tokenize into real world assets on chain? And, what is the point of all this? What would you say it mainly solves to have these things on chain?
I'll say that there's two features of tokenization on public blockchains generally, which is standardization and automation with smart contracts. And that leads into the value adds, which is very different depending on the asset and who cares about it. It's actually kind of like two worlds here. One is for benefits of accessibility. So we're seeing that right now with stablecoins. So letting people have broadly access to the dollar where it was not possible to do that before. And then the second one is cost savings or efficiency gains, again, via that automation. And so stablecoin sort of hit both of these use cases, which is probably why they've done so incredibly well over the past few years, where not only, you can now access dollars, very high demand asset all over the world, and you can use them for very, very efficient payments, whether it's cross-border or intra-border, bank to bank, bank to business, doesn't really matter. It's all the same thing. It's all standardized, and it's able to be automated. Whereas for different assets, like private market assets, let's say a private credit fund, it's almost entirely about accessibility. So private credit, private equity funds, these are asset classes that are actually the best performing in the last 10 years in terms of their Sharpe ratios. But ownership among even very high net worth individuals is less than 10% on average. It's really an asset class dominated by allocators, so pension funds, insurance funds, and ultra high net worth individuals, 100 million net worth plus, who actually have alts as 40% of their portfolio. So it's a very stark difference in portfolio composition between ultra high net worth and very high net worth, even though people tend to sort of like mentally group them in the same place. And a lot of these large players, the fund managers, so again, like Franklin Templeton, Brevin Howard, Hamilton Lane, they want to have more people own these assets in the very high net worth, even just regular high net worth category. But it wasn't possible because it's so intensive to keep track of the ownership of all of them inside of the traditional transfer agency system. It's very expensive. Actually, an interesting stat from the recent conference that was RWA Summit conference was that the head of digital assets at Franklin Templeton, he said that it's using blockchain as a transfer agent, so keeping track of ownership and transfers, is 30,000 times cheaper than doing it in the regular system. So it costs about $1 to do it in regular markets. So it's like, let's say it's like, me sending you a stock, it's about like $1 on average, or a fund. But then on a blockchain, it's literally just a transaction fee, right? So it's a lot cheaper. And he was saying it was $1.50 for 50,000 transactions versus $50,000 in the regular system. So you can see why a lot of these asset managers are starting to pay attention, just because it unlocks massive cost savings for them and enables, through those cost savings, widespread accessibility to asset classes which do not have this, which don't have that many individuals participating into them.
Okay, very cool. So you mentioned standardization. I think I agree that this is a big deal, and everyone going their own route is not really practical. Are you seeing all these RWA issuers like having the same standardization, or are they kind of all going into that direction, and you have to do the job of checking their liquidation engine, which is different from BlackRock's, which is different from, I don't know, all these different key players? Are you seeing some collusion, I guess, across the industry, or not yet? And how has that been for you to ingest in terms of data?
It's actually a very ongoing mission to enforce standardization, where we're one of the founding members of the Tokenized Asset Coalition, which was founded for primarily one of these reasons. So it was Coinbase, Circle, Credit, Centrifuge, a few other different players that founded this. Now there's 30 or more players involved, and we want to continue to push people to use the same standards, both in terms of the token standards. Thankfully, people tend to use regular token standards, so ERC-20s, 721s, 3643, 4626, just because they're easy to get stood up with, and pretty much no one will work with you if you don't use something like that. But for the data standard, it's really just still all over the place, and there's not anything that has taken hold just yet. So ongoing challenge for us that we want to have people send us data in the same way. but not always possible. I mean, if you look in the traditional finance system as well, I don't know if any of you have worked with not even just regular banks, but which are hard enough to deal with their APIs and their data dumps. But working with a custodian bank, I promise you, is even worse in terms of the tech stack that they have available. So it's not only a problem in crypto, it's actually much worse in traditional finance. So ongoing problem that we're trying to solve.
Okay, very interesting. I was also surprised by what you say about how sending a stock is like over $1. In my head, I assumed there was a line appended to an SQL ledger, and that's like cost free almost. But I guess not. To me, that was kind of the benefits of centralized systems, where it's all in your ledger and you keep it in your database, which is basically free. But I guess not. So that's another thing blockchains can add to this, other than composability, is also just in general fees, which is great. And I didn't really foresee this as a thing to solve, but that is very interesting. I want to look into the website. I think that should be very interesting. And for those only listening, I encourage you to check it out, which is on app.rwa.xyz, and it has a ton of data. I don't think we have time to even go through half of it. It's insane the amount of data you've processed. Having worked on dashboards, I can tell that a lot of work has been put into this. So I do appreciate you putting in the time and putting it out there for free. And I had a question, which is, if I go, yes, so into US Treasuries, you have a chart that breaks down the TVL of US Treasuries on chain per chain, but there's one of those chains that stands out to me, which is off chain. And I was curious what this means, why this is here, and isn't that just TradFi, or is that very different? What may I be missing here?
Yeah, this is a very interesting category because what actually has to there's like a technical process that has to happen before you're able to bring in an asset on chain. And so for something like a USDY with Ondo, which is actually not in this category, but we should add it, which is that they need to bake, quote unquote. It's not a technical term. There's some like legal regulatory term, but before they mint it fully on chain, they actually have to process the assets and hold the treasuries in reserve for a certain amount of time. So it's not technically, it does serve the tokenized asset later, but it is not technically on chain yet. And so we're still, the off chain moniker you see here is our attempt to portray it correctly. And so we still need to obviously have some more explaining to do on what exactly it means. Similarly, someone with like Superstate, again, they have a asset manager on chain started by Robert Leshner of Compound, and they have some clients that don't necessarily want it to be on chain yet, but they still want to have the benefit of me participating in the fund. So it is a tokenized fund, but some of it is still managed off chain, and we still want to track the numbers that are in these tokenized funds, even though not all of the AUM might be fully on chain yet. It's just one step towards that.
Okay, that makes sense. So it eventually comes on chain, but for the time being is off chain due to being packaged into other products that are on chain, but these aren't. So okay, yeah, that makes sense. Very interesting. And I think there seems like there's a lot of curation work to be done in terms of data, because everyone does it slightly differently. And like we said before, in terms of tokenization, it's a spectrum, and that's not the only thing that is a spectrum to evaluate. And one of the things I found interesting is how on your website there's a stablecoin section, but it's not part of the RWA. Do you see stablecoins as, in terms of like in this gray area? How would you assess them? Yeah, would you assess them very differently from the rest, or why are they here, but in a separate section?
It's actually mostly user-driven feedback as to why stablecoins are in this separate section, where the numbers by themselves just completely dominate. Actually, if you go back to the market overview, we have a button on the main chart which is include stablecoins. You can just click that.
Oh yeah,
and you'll see that you actually cannot really see the other information if stablecoins are listed on here. And so it's actually mostly a point of practicality in terms of data visualization that we have to exclude stablecoins from all the other data, because it just is so successful that it dominates every other data point here, and you can't even see any of it. You see that there's 130 million or so stablecoin holders, but only 65,000 or so holders of other assets. And if we just showed the 129 million stablecoin holders, a lot of people didn't necessarily view that as that wasn't the data that people necessarily wanted, and so we thought it best to split it out.
okay.
What do
That
you
makes
count
sense.
as a stablecoin holder here? Like how does the data pipelining for this work?
Yeah, this is by far our biggest pipeline. I think we actually store like 15 or 20 terabytes of data actually for all these holders. So we have the full balance history for every single day for every single holder. And so we collect it from, I think, like 18 chains right now. And we just take all the raw transfer logs from every single chain for all these stablecoins and compute the balance every single day for every single one. And then you just count the uniques at the end of that, and you get 129 million.
Is there any like qualifying criteria, like over $10, or is it literally like 0.001 cent, and then I'm counted as a holder?
Yeah, so we actually wanted originally to have some qualifier, so if you hold less than $1 or something, but when we originally put that on the site, we had so many people tell us that our data is wrong because it doesn't match with Etherscan. And so again, more of a point of practicality, where people just thought that we were like, it made them trust all of our data less because we didn't match with Etherscan, even though our number was more quote unquote useful, or we thought it was useful. So we actually had to go back to using a zero threshold.
Wow. So your users made you go backwards. I mean, I totally understand. Like we as Dune, as a data provider, we oftentimes get these things where it's like, like, what are you doing here? Why is this aggregated in this way? And it's like, it's a real communication challenge to kind of get people out of these old habits of like, we're using TVL, or like we're using daily active users, which are all like kind of meaningless metrics. And I guess you are in the same vein here, where it's like, okay, like we were smart and like we are applying some algorithms to qualify users and like all of this stuff, and it's like, oh no, like we just want the raw numbers. Interesting how that happens.
Yeah, we actually have to sort of maintain like two product docs internally, because one is for the public facing dashboard that deals with stuff like this, and then the other one is for people who pay us a subscription to download data, use the API, and access some other pro app features, where the data they want is holders, like actual holders with who will hold more than a certain threshold. And so we'll give them that. We just won't show it on this sort of page. And there's all sorts of things that are like that actually throughout this dashboard, where where the user facing version has to be different than, or the public version has to be different than what we actually sell.
It's the interesting dynamic that we also face making dashboards, where BT teams want to have high numbers and non-curated metrics, and analysts are into actually, curating those and maybe using heuristics into those to actually get the noise out of the data. And that's a hard problem to fix, because the BD teams are the ones who govern what it gets posted on Twitter profiles and stuff like this. So it's a weird battle to fight, but I think it's a worthwhile one, and it does make sense. It comes from the interest of the person looking at the data and what they want to get. Do they want to see chart go up, or do they want to see the actual data? I think that's also comes down to this.
I want to inject a small question. So just looking at the market cap chart, right, on the right side, TRON, right, is pretty much amazing to see here. And we know it's because of stablecoin, and they get basically trolled on all the time because Justin Sun is a character. But hey, they're doing pretty much most of the job for stablecoin markets.
If you click on active addresses here, I think this is actually one of the most interesting charts where, and group by network.
Yes.
Yeah, well, you see that TRON continues to dominate in terms of the number of users that are sending stablecoins here, where they have almost as much as every other chain combined, which is really, really crazy to see. And, of course, we don't know for a fact that they're all real, quote unquote, users or bots with real productive use cases. But they're, in the digging we've done, there actually does seem to be more real activity on TRON and more sort of quote fake activity on things like Binance and Solana. And so we actually do think that the TRON figures here are not overinflated compared to the others. And so it's really wild to see, TRON getting a lot of disrespect, let's say, on crypto Twitter, at least in the West. Yeah, but they just absolutely dominate in terms of real activity using stablecoins, and of course, all that activity comes from Tether. USDC actually, Circle just stopped issuing on, and they're going to wind down USDC on TRON. And so, actually, a lot of people I know will go as far as to say that TRON is an app chain for Tether, effectively. And it's not untrue looking at the data.
I think it comes down also to TRON being popular, not necessarily in the West, but in I think in Africa, I've heard of it being quite popular there. Maybe Asia, but I'm not sure. But yeah, it's just not a network that I personally interact with or see all around all that much. So it is surprising in terms of data, but it does make sense if it's used in other parts of the world.
Yeah, two anecdotes here are that in Turkey, you have the Grand Bazaar where people are just trading whatever. And apparently the majority of vendors who accept stablecoins are doing it with USDT on TRON. And there's some gold vendors, like physical gold vendors, where you can buy, you can buy gold coins or bars or whatever. And these guys do hundreds of millions of dollars of volume, like in a given year. And it's, most of it is just flowing through Tether on TRON. And then the other one is that, tons of different market makers are just using TRON, USDT on TRON to settle between each other for everything.
If we look at, in terms of comparing active addresses to transfer volume, I guess the average volume, since Ethereum takes the lead in transfer, I'm guessing TRON has much lower side volume, so it's probably used more by retail-facing customers than Ethereum, being more maybe institutional in usage, or whales and such. So yeah, very interesting. I think it's just different dynamics. I still find it hard in general to compare, like we touched on before, metrics such as holders and transfer counts and stuff like this, given that different chains act differently and they have different costs transaction, and some are easier to game, stuff like this. So there's just different dynamics at play, and it's very hard to have metrics that encompass all these in a fair way, because there's always a bias in the way you present the data, whether it's raw or whether it's highly curated. And that's probably a problem that is going to be ever growing. But being the dominant player in terms of RWA data, I think you guys are in control of the narrative and the data, and you guys get to choose what becomes the status quo in terms of how we quantify these metrics. So, the curator role, I think, is very interesting and probably underlooked. Most people see analysts as just, making data visual, but it's actually a whole lot more than this, and there's so much interpretation to be done. And yeah, so very, very interesting approach, and I think it's really cool, the depth and the amount of data that you surface for all these
Thanks.
trainer.
Yeah, it's
stuff
actually
as well.
very what you're talking about the power of curation is that a lot of people actually associate us with having even solidified the term RWA, where before so many people used like either tokenization or RWA, which was originally coined by Centrifuge, or one of many other terms off there. Like there's OnFi that Avalanche is pushing, or one of many other terms that people try and switch to. But because of our website, I think that it's sort of the industry has sort of coalesced around the term RWA, and everyone seems to use it just because our site is out there and has data on quote unquote RWA, so people just go with it. Even though I will admit it's not the best term.
I think we kind of know, we kind of associated the name with what it is. So at this point, it's it is defined, and people usually know what it means or what it's supposed to represent. But like we said before, when we talked about the definition, it's not black and white, and there's no hard definition that everyone agrees on yet, because these products are there's always slight differences between each of them, and these protocols behave differently on different chains. They aim to serve different clients. So there's all these considerations that need someone to curate in order to compare who has the market share. Because if you want to know who has the market share, like what do you even consider as being part of this sector is the first question you should ask. And those are often overlooked questions by other players and people looking from the outside view. But it's very important.
We also had the question in our head where it's like, great, now with RWA.xyz, we know how much TVL there is or total value locked in the RWA assets. How does that compare with DeFi or DEX today? Is it like, like tenth of the volume, or is it like comparable? I don't know if you have that comparison on top of your head.
Yeah, it's actually interesting because most of the volume inside of lending markets and DEXs in some way involves a stablecoin, and so the two actually do tend to converge if you're including stablecoins. If you do not include stablecoins, yeah, it's much lower. There's really only, I don't know, like 4 venues really where you can even use like a U.S. Treasury or a stock or something like that inside of a lending market. But I think that this will become much more. This will become a much bigger trend in the future, hopefully in the near future, because a lot of the people that we talk to in traditional finance, they actually view it as the entire reason to tokenize things, which is that through the standardization and automation we talked about before, you're able to use it in DeFi and able to automate so many of these different functions that would normally cost so much more. Like let's say that you as a retail user want to borrow against some T-bills or borrow against your whatever Tesla stock, right? Are you going to be able to do this now? Not in traditional finance at all. And the reason is that it's very expensive for them to be able to administrate all of those functions. But using blockchains, then someone like a Robinhood will in the future easily let you be able to do that, and they're going to be able to generate so much money by allowing this to happen. And you can argue whether it's good or bad thing for people to borrow against their Tesla stock to buy more, but regardless, people want to do it, and financial institutions want to enable people to do it so they can make more money.
I think composability and using smart contracts that have timely liquidation can aid a lot compared to the current system, where some of the some bonds are very opaque and what is actually in there, and the quality of bond is not as transparent. So I kind of see RWAs moving this forward in a really great way, where it's much more transparent and liquidations are timely. Stablecoin currently heavily dominate, with the rest being negligible in terms of CVL for RWAs. do you foresee that changing? And do you see the rest of RWAs maybe even overtaking stablecoins in the near or far future? And what would you say is missing for that to happen if you foresee this happening?
It'll eventually happen, but it is going to take an extremely long time. If you look at just if you zoom out and into like regular markets, traditional markets, there is more M2, or there are more assets than there is M2 money supply, but most of that is in government debt, and I don't think that the U.S. government will be issuing treasury debt on a public blockchain for a very, very long time. I think that's basically what will need to happen before it's able to overtake stablecoins. So I think it'll be a very long time.
Okay. But yeah, I think it'd be great to have, all of TradFi eventually move on chain and have all these products become more transparent for everyone involved. Another thing we touched on is composability of smart contract, but also assessing those gray area, which aren't always black and white. And I'm not sure if you looked into EigenLayer's launch lately, and they have this way to evaluate facts that are intersubjective. And I think in RWA, in the RWA space, there's a lot of those, evaluating the quality of bonds and stuff like this. Do you foresee this as playing a role? And, maybe not EigenLayer, but EigenLayer like fact evaluation being a thing in crypto and especially for RWAs?
Yeah, this is actually, so broadly, this would probably fall under the category of us doing ratings, let's say. And so we actually do get asked for this all the time. But I think that it's like I think there's like, you can break it down two things, right? It's like, should ratings exist on RWAs? Yes, unequivocally, I would say. And then are ratings able to be done better using a system like EigenLayer? I think in theory, yes, but no one has been able to do it yet. Like, you could have a system where everyone tries to come to an intersubjective consensus on the best way to do things and use EigenLayer to coordinate that, and you tie that to financial risk in some way, same way that normal rating agencies do it, but you crowdsource all of that work, and yeah, maybe you have a token to reward people for doing it, and then you get paid based on like the outcome of if the product blew up or it didn't. So it kind of evaluates itself actually as a space to insurance in a lot of ways, due to the financialization of it. And maybe there is someone out there who can come up with a token design that does not evaluate to basically doing insurance on financial products. And if you do, let me know, because I'd be interested in taking a look. So I think it is possible, but insurance so far is an unsolved problem within DeFi. I don't think anyone's been able to crack the code on that. So until someone's able to do that, and maybe they do it in the context of providing financial ratings, I don't. Yeah, it's unclear to me if it's possible, basically. But it would be very, very cool if it is, because that is kind of the whole point of crypto, right? So we're replacing centralized trust, which is the financial rating agencies like Moody's, S&P, Fitch, Cobra, etc. All these guys, which are fallible, obviously, as centralized players, and then actually being able to do that same job with a decentralized system, that would be amazing. But it's unclear to me if it's possible.
Okay, very cool. So we know regulation, like the rest of the crypto industry in the US especially, are stifling growth a little because of being, maybe unclear or whatever. Do you see other blockers in terms of RWA adoption, in the technical aspect, what do you think could be the next unlock into getting RWA regulations aside once again?
I think that the technology is not a blocker. The technology is definitely more than good enough at this point. I think it is two things, like you said, regulation, and just one quick anecdote there is that there are multiple public banks, large banks that we talk to that are currently doing things in private blockchain permission settings. And they say they're just waiting for clarity in order to do that on public blockchains. And that a lot of them view that as being the future. And pretty much the only thing stopping that happening is regulation and policy. And then you also have what I would say is just the same thing that stops technology adoption in traditional finance broadly, and that is just institutional sluggishness or bureaucracy, let's call it. So unfortunately, some of these things just take time to happen. I mean, there are trades that still happen in very large sizes in prominent asset classes that are done using fax machines. And so for taking that all the way to using a smart contract on a blockchain, maybe those people will be here in 20, 30 years. And they're going to, maybe in 10 years, they'll be using a computer for those trades. Like, imagine that. Some of them probably just started using email. So it's a very antiquated system and just takes a lot of time, unfortunately.
Okay, yeah. I guess we're at the forefront of this technology, and sometimes we need to take a step back and realize that it takes a while for others, especially in established industries, to come on board and accept that maybe this is a better way forward. And it takes time to convince those people, especially when it challenges existing systems that have been proven to work in some ways, but maybe haven't been considered. It hasn't been considered that blockchain could help solve some problems that also are faced. Very interesting. I think I saw also a while back during the NFT craze, and I'm not sure if this was real or a meme or whatever, but there was a house on sale on as an NFT. Do you also see, because I would love to see the whole housing market move on chain, and anyone could have transparency into what is actually available, and all the clause and everything. Do you see this as a potential future in terms of retail oriented and even investors? Or do you think we're also very far from seeing this happening? Is there any adoption in that regard?
Very timely question, actually, since we are working on our real estate section right now, and it will be out in a matter of hopefully weeks, fingers crossed. So this stuff takes longer than we want it to. And I think a lot of people want it to be the case that you can bring your house on as an NFT, and then you can use whatever Blur Lend or something, NFT lending market, to take out a mortgage against it. But I think what's actually seems to be happening is that for the vast majority of lending and equity holdings, basically the financialized products around real estate, is that the majority of them, you don't need the house itself to be represented on chain, where you can actually have massive gains in the process of mortgage-backed securitizations, and without having to quote unquote tokenize the house with all the legal rights. And like if someone all the hairy problems around, if someone steals your NFT, can they move into your house type of like weird problems. And so if you look on our site, if you look at Figure and the work that they're doing, it is lending against home equity. And so they don't need to put the house on chain in order to have massive benefits in order to do that. They anecdotally are able to save 1% on all the securitizations they do just through doing the packaging of it on chain. So taking the loans across hundreds or thousands of individual loans, packaging them up into one security, and then doing all the risk tranching, waterfall math, etc., loan data aggregation on chain, and they're able to save a absolutely massive amount. And actually, at this point, Figure is, I think, 34% market share of all home equity line of credit in the market. They're by far the largest non-bank HELOC originator. And the big reason for that is because they use a blockchain to make their processes a lot more efficient. And in doing so, they're able to offer like 50 basis points better rates than a lot of their competition, which is very attractive for consumers and gives them a real business edge, which is why they've done so well. So all in all, we are starting to see more traction here, but I think unfortunately for a lot of, but it's not going to play out the way that people think it will, where yeah, you can like mint your house on chain. Although there are a lot of people trying to do that, and I'm not saying that it definitely cannot work, but so far there has not been traction in that exact thing just yet.
Does Figure own the relationship with the actual borrower, or is that kind of local banks and then Figure buys those loans?
Yeah, so it is direct.
From them?
So if you go to Figure.com and you have home equity, you can get a line of credit against it, and then they will, before they syndicated it to banks, but now they are doing the packaging into securitization. So, I mean, if you had access to the securitizations market, yeah, you could buy like this HELOC. Like Apollo and many other lenders are the primary sponsors of it.
So we already have definite proof that blockchains are an improvement if they're able to offer those at lower in terms of basis points compared to their competitor, which is great. I think it's a good proof of concept, I guess, if we can call it that for now.
This was a really informative episode for me because I'm the type of person who is like, when it comes to RWA, I can only think of, okay, when can I buy a house on chain before this episode? So I really learned a lot. And yeah, it's amazing to see the dashboards on RWA.xyz. Maybe I have one last question, more towards the product itself. Because I know basically you're building a data company, and in general, the data company is a hard business to do. Like, first of all, the data vertical is quite saturated. There's many other data providers and like SaaS business. I can see that RWA.xyz can serve as like a specialized, knowledge portal for specifically RWA vertical. And I see you guys have like API offering and potentially also to business, like more deep analytics and research kind of service. I'm curious, like, what's the overall, like, I guess, mission, vision, like, outlook and roadmap that you plan for RWA? Like, I understand there could be to C and to B. Do you expect to work more with institutes from the TradFi side, or do you plan to, like, build other tools?
Yeah, really good question. And actually, one funny anecdote about that market saturation is that when we were still in the Solana space, I was actually talking to, I don't know if you guys know John at Artemis. He's founder of Artemis, and he was telling me about his idea, and I was like, data market's so saturated. Like, I don't think it's a good business. And he reminds me of that now because obviously we're both in data businesses that are doing well. So not as saturated as I thought before, obviously. But in terms of our roadmap, our mission in general is to accelerate the adoption of public blockchains use and other ledger technologies use in traditional finance, and to generally improve the financial system. We and a few other players use the term like, upgrade the financial system. It's well past overdue, and so that is our North Star, and we think that through data. Data plays a very, very large part of it. In terms of where we're getting revenue from right now, we do primarily sell to financial institutions. So our first customer was Moody's on the analytics side. And so they were, using our reference data for stablecoin assessments. Let's call it. Not technically allowed to use the word ratings here. It's a regulated term. And similarly, there's a lot of other we're luckily able to use their name, but there's a lot of other players where we're not allowed to use their name and list them as a customer, but it's for broadly similar use cases. And starting to see more interest from traditional news sources, and also starting to see some interest from more crypto native players, some DeFi protocols that are interested in doing integrations with real world assets, showing them on their site. And in order to give users context for all that, they're going to need the data. Starting to see more movement in terms of selling to the issuers as well. So a lot of people will use our site for competitive analysis. So it's like, okay, who else is getting traction? What are the other market segments that what should we go into next? What geos are getting distribution? What DeFi protocols are other people trying to get distribution into? Who's having success where? Questions like that we're in a position to answer right now. But yeah, to your point, it's very hard to do product work in the space sometimes because data is naturally used for many different things. Like I think, yeah, if you'd asked the Dune founder, it's like, what is the data used for? It's a much harder question than it seems because there's so many different things. And as an early stage startup, you can only focus on so many. And so it's kind of, our goal is to just place concentrated bets into like things that we think will succeed. And so far, those are the ones that are working out.
Yeah, I have the opposite view to John from Optimus, where I don't think it's the data space is saturated. I think we lack analysts right now more than anything compared to what there is to analyze, and I think we're starting to see more and more players like you guys who specialize in a very specific sector. We recently hosted Sorella Labs, who does this on MEV, and to be honest, I tried to surface MEV data and I did it on a surface level, but it's so complex. There's so many technicalities that either you're 100% into it and, obviously you're going to be the best at it, or if you do it in a very limited way, you can never catch up to whoever has done it the full work. So I think there's a ton of value to people like you and RWA. And I'm sure as time goes, it's getting increasingly complex to curate all this. So it's also, getting increasingly hard to catch up to you guys and be a competitor. And given that your data is public, I don't think there's much of an edge to be had on a product like you guys are proposing. So yeah, thank you for putting this all out in the public and available to all. And overall, I think this has been a very insightful episode. I learned a lot. It's not necessarily a sector that I'm very familiar with, and I think it can be a little scary at first because it's not very developed yet on crypto, and it's not the things we're most familiar with. But I really appreciate you taking the time to talk to us about all this and explain the whole process and what RWAs even are. So yeah, thanks a lot.
We have a section in our podcast that's called Chart Crimes. What's one, and I guess you haven't brought a specific chart, but what's a common misconception that you see people kind of using the RWA words, or like what's a metric that you absolutely hate in your space that people are using?
This might be a controversial one, where I absolutely hate the term TVL for use in like our space. Because if you go by like what it actually means, it's like value locked inside of the DeFi contract. Like that's money that's just sitting there, and so by definition, it's not productive. So like if you take out a loan, or if you facilitate a loan on chain, your TVL, like if you're doing it right, should be 0. And so by calling everything like TVL, I think it's it makes people's protocols, or if they actually use the metric correctly, it makes people's protocols seem extremely low and like bad basically. But in reality, it's like they're the ones that are doing it right. If you have a lending protocol where the TVL is like $1 billion, that's a problem, because that means you have $1 billion that you're not doing anything with.
I see. Yeah, capital efficiency is going towards 0, I guess. Yeah. Cool. Interesting. Yeah, I can only follow Dobby. Thanks for coming on. Very interesting work. I think the fragmentation of the data space and like these curating functions are really, really important. So I really value the work you're doing in kind of bringing the space forward, moving away from active addresses and holders. We're still working on. You and your community will figure it out eventually. But yeah, thanks so much for coming on. You have listened to the Index podcast. Share this with your friends. Share this with your colleagues, your family, of course. They're probably really interested in RWAs. But yeah, thanks so much for listening, and we will catch you in 2 weeks. Bye-bye.
Crypto data wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar, we call them out and set chart crown on fire.